Well, hello everybody, and welcome to another edition of Hawk's Scan Sentry Report. I am Hawk Arps, Vice President of Jan Arps Traders Toolbox, and this is the report for the week beginning May 5th, 2014. Well, it's been a while since we've recorded one of these blogs, so I think today we're just going to kind of look at the relative strength of the different markets relative to the S&P, maybe take a look at some gold and crude as well. So let's jump right into it. For those of you unfamiliar with this is my ESignal Watchlist designed to show me the strength of different market sectors relative to the S&P. And the way we do that is by creating these synthetic symbols based on various ETFs relative to the SPY ETF. So, for instance, here you can see I have the Dow versus the SPY, the Russell versus the SPY, the NASDAQ versus the SPY. And then on this watch list I have each of these ETFs by itself so that I can do some analysis and then click on these two watch lists to charts that are linked to these particular symbols. Now on these watch lists I have parts of the Arps Scan Sentry toolkit applied, and these tools show me how many bars ago different signals occurred. For instance, here I have the Trend Exhaustion 1 TTB, Trend Exhaustion 1 tool, which shows me how many bars ago Radar 2 fast line crossed the slow line. And the next tool I have here on this watch list is the TTB Triple Trender, and the main thing I'm going to look at on that is the score. This is how I'm going to identify the relative strength of each of these synthetic symbols, the relative strength of each sector relative to the SPY. And I have a Radar 3 Scan Sentry tool here, as well as just a simple fear greed. So I use the score column to help me analyze the strength of each of these symbols relative to the S&P. And in this case, when I'm looking at the indexes, I see that both the Russell and the NASDAQ are very weak relative to the SPY, -6 and -5. -6 is as weak a score as you can get on this tool. So realizing that these are the indexes that led the S&P up in the rally that we've been in for the last year or two, particularly the Russell, it might be a caution to see if these will lead in a rally down. Right now the Dow Industrials are the strongest index, and they're pretty much break even with a score of 1. In the next column here I have different sectors of the market relative to the S&P, and when I look at the score of the different sectors I see home building is weak, biotech is weak, all of these negative numbers relatively weak, financials weak. The only strong numbers in the score, the positive numbers here, are the utilities with a score of 6 and the consumer staples with a score of 4. Now, it's also common knowledge that utilities are a sector that big money moves their money into when they are worried that the riskier sectors like biotech and other technology, consumer discretionary, when they're worried that those markets are not likely to keep rising, they'll shift their money into a more stable sector like utilities. And of course consumer staples are considered a standby as well, because people will always need to buy the staples. So this kind of analysis leads us to believe that there is some sense of potential toppiness in the market. Now if I click on each of these symbols in each of these watch lists, they are linked to charts which we're going to look at presently. On this side I have charts with the relative strength synthetic symbols, and then the gold line is the SPY itself. This is a daily chart on the top, a weekly chart on the bottom. And on the left I have the actual symbol. So we clicked on XLU, so this is a daily XLU and a weekly XLU. Let's take a look at the synthetic symbol for a minute. Now you can see as the S&P was rising, has been rising, that the relative strength of the utilities has been downward to even, sideways to downward, until we had this big scare back in the beginning of 2014, and when the market went down, the utilities went up. Well, now we see the utilities have been going up again in spite of the fact that the market is kind of going sideways. And when we look at some of our other indicators, like the fear-greed indicator down here, we can see that there has been strengthening buying in this sector since about January of 2014, which is when our bullish trend in this sector was confirmed. Now if we look at the XLU daily by itself, we can see that it's a pretty stable ETF, kind of going very sideways. But notice right here, about the first week of February, we had a breakout from this range, and it's been moving up ever since. So to me, this is an indication that there's a higher demand for the utility stocks than there were before. We can apply this same sort of analysis to some of the other markets that are significant. For instance, looking at the different markets such as treasury bonds, dividend stocks, copper, which is often thought to precede the S&P, high yield junk bonds, junk stocks, so to speak, gold versus the S&P, oil, etc. Looking at these, we can see that none of them have a particularly strong score. The dividend stocks are relatively strong but weakening. I can see that by the fact that they're pink. And oil is moderately strong but also weakening. When the score moves down, the score column will plot pink on that bar, and if the score moves up, the score column will plot green. So in this case, we can see that this strong markets of dividend stocks and oil are temporarily weakening. Again, dividend stocks are more likely a flight to safety than some of the others. Here we can look at some regional ETFs too, if you're interested in investing in certain regions. Right now we're seeing that the Canadian markets are particularly strong, as well as the Great Britain, and we can see that I believe that's New Zealand, Thailand, and Turkey are also relatively strong. Let's take a look at the oil market and the gold market for a moment. First, let's look at it relative to the S&P. So I'm going to click on oil and take a look at the associated charts. Okay, here are our charts again, and if we look at the daily relative strength chart, we can see that oil has made some extreme highs relative to the S&P and is starting to taper off relative to the S&P. That could mean that the S&P is starting to catch up with these oil stocks. We use the same kind of analysis from our fear-greed indicator as we would on a regular price chart, and that's showing us that the buying pressure is still very strong. The oil versus S&P is still a strong sector. If we look at the actual oil chart for a minute, at least as far as the DIG ETF is concerned, we can see that it's in a strong uptrend and not showing divergences at the top, but we are seeing trend exhaustion signals letting us know it might be time to sell, at least temporarily, from an upward move and look for a pullback to re-enter. Let's take a look at gold markets relative to the S&P for just a moment. Now this is interesting. in our daily relative strength chart, although gold has been bottoming for about 5 or 6 months now, we see there was some buying pressure up into March, sold off. But look at the divergences in Radar 1 in this market now. This is relative to the S&P. We're seeing some divergences that might indicate some upward movement in gold. We're still clearly in a bearish market, but let's see what the actual gold ETF itself is showing us. If we look at the weekly chart, we can see there's been, after this beautiful bullish divergence, we've been getting quite a lot of buying, and the Radar 1 Fear Greed indicator has been showing us that. And if we look at the daily, we see the same kind of divergences down here in this consolidating pattern. So although the selling is stronger than the buying, we are seeing divergences with an indication that gold will potentially move up sometime soon. I want to thank you for taking a few moments out of your busy week to follow the Sentry report. I hope you've gleaned something good from it. I want to remind you that Young Arps Trader's Toolbox is not licensed to be giving any actual trading recommendations, that everything shown here today is for purely educational purposes. So with that in mind, may your trading go well, and may the trend be with you.